Welcome to The Explainer, where we break down big ideas using the source material itself. Today, we're jumping into an investment philosophy that really goes against the grain of a lot of common financial advice.
So let's start with a really powerful idea that comes right from our sources, this whole problem of control. The text used the 2008-2009 financial crisis as a huge wake-up call. For millions, it wasn't just about the money they lost. It was that absolutely gut-wrenching feeling of being a passenger in a car speeding off a cliff with zero ability to grab the wheel.
And that question, right there, is the very heart of the philosophy we're exploring today. It suggests that maybe, just maybe, the biggest risk you face isn't a crazy market. Maybe the biggest risk is that you've given up your ability to do anything about it. It completely reframes risk from something you just have to suffer through to something you can actually manage.
So it all boils down to two very different goals, two totally different ways of looking at your money. And the path you pick, according to these texts, pretty much determines everything. Your risk, your taxes, and, how well you sleep at night.
Okay, so first, there's investing for what's called capital gains. Now, this is what most of us are taught to do. You buy a stock, you buy a mutual fund, maybe a house, and you cross your fingers and hope, or as the source material would say, you speculate that the price goes up. The entire strategy is built on predicting what other people will be willing to pay for it in the future.
But then there's the alternative, investing for cash flow. And here, the focus just completely flips. You're not really worried about when or even if you'll sell the asset. What you care about is what that asset produces for you right now. It's like getting a paycheck from your investments, month after month. Let's really put these two side by side. The capital gains investor is kind of like a fortune teller, They're focused on a future price that's totally out of their control. But the cash flow investor, they're a business owner. They're focused on how their asset is performing today. One strategy is based on hope, the other is based on production.
Now, this is where the sources really don't pull any punches. They straight up call investing for capital gains gambling. Now look, plenty of people have made money this way, for sure. But the texts argue it's fundamentally a bet. Cash flow, on the other hand, is framed as a much more stable, business-like way to go, where you're just collecting predictable income instead of betting on a lucky number.
And this slide right here gets to the main event: control. When you buy something like a mutual fund, you're literally handing your money over to a fund manager. You have zero say. But with cash flow assets that you own and operate yourself, you're in the driver's seat. You get to manage the income, you control the expenses, you decide on the debt. It's all you.
So you're probably asking, okay, I get it, cash flow and control, but how do you actually do that? Well, the sources argue that while this philosophy can be applied to a lot of things, there's one asset class that's almost perfectly designed for it: real estate.
The material points out these four key advantages that all work together. You get cash flow from the rent, that's your consistent income. You still got appreciation, but it's tied to real things, like you improving the property or raising rents, not just market craziness. You have total control. And, this is a huge one, you get amazing tax advantages. Now, for anyone thinking that being a landlord sounds like a ton of work, the sources do mention vehicles like REITs, that's real estate investment trusts. These let you buy into a big portfolio of properties so you get the income, the dividends, without having to manage the property yourself.
This is such a key idea. Let's just play this out. Imagine the stock market crashes tomorrow. Boom. The value of your stock portfolio gets sliced in half overnight. But if you own a rental property and its Zillow estimate drops, what happens to that rent check that's due on the first of the month? Absolutely nothing. It still shows up. Your income is protected from all that daily market drama.
So the sources lay out this pretty clear, repeatable playbook. It's not just about go buy a building. No, it's about finding a deal where the numbers work from day one, using a mortgage as leverage to buy a bigger asset, managing it like a real business to make sure there's money left over each month, and then using the tax code to legally keep more of that money.
And a huge part of this is just knowing the rules of the game. It's about financial education. The sources point to specific tools that sophisticated investors use all the time. The 1031 exchange, for example, is basically a wealth-building cheat code. It lets you sell a property, take all the profit, roll it into a new, bigger property, and legally pay zero capital gains tax. It lets your money grow so much faster.
All right, so we've talked about the cash flow model. Now let's flip the script and see how this philosophy views the kind of investments most people have. Stocks, bonds, and mutual funds.
Wow. This quote is a direct shot at mainstream financial advice. The source material is basically saying that the very thing you're told is safe and smart is actually the riskiest thing you can do precisely because you give up all your control and you're just gambling on prices going up.
You see a chart like this, and it looks responsible, right? But from the cash flow perspective, this is a disaster waiting to happen. Why? Because every single one of these slices are what the sources call paper assets. You own a piece of paper, a stock certificate, a digital entry in an account, but you don't own the actual thing. You have no control, which means your whole portfolio is vulnerable, no matter how diversified it is.
This comparison is just perfect. I mean, seriously, could you imagine buying a rental house and just letting it sit empty for 2 decades? You're paying taxes, you're paying for upkeep, all in the hope that you can sell it for more 20 years from now? It sounds absolutely insane, right? And yet the sources argue that is exactly what millions of us are doing with our retirement accounts.
So at the end of the day, the big takeaway here isn't just real estate is good and stocks are bad. It's much bigger than that. Whether you're talking about rental properties or a business you own or even dividend stocks, the strategy is about a huge shift in your thinking. You stop chasing a number on a screen and you start building an actual system that generates income.
This is the daily mindset. It's about actively taking your cash, which loses value every day because of inflation, and turning it into things that work for you. You're not just saving money anymore, you are deploying it. You're building an asset column that pays you whether you go to work or not. And this right here, this is the pro-level question. According to these texts, this is how a sophisticated investor thinks. It's not just about how much money you can make, it's about how fast you can get your original investment back out. Because once your money is back in your pocket, you still own the asset, and it's still producing cash flow for you, essentially for free. That's what they call real financial intelligence.
So, ultimately, the sources leave you with the challenge, a question to ask yourself. Take a hard look at your own strategy. Are you just building for net worth, playing a guessing game, hoping the market goes your way? Or are you building for cash flow, methodically putting together an income machine that pays you no matter what the market is doing? The choice, they say, is yours.